The CNN Fear and Greed Index is currently sitting in extreme fear, and in the midst of this market volatility, REITs continue to be trading at one of their lowest valuations in literally decades. The U.S. real estate versus U.S. equities earnings multiple spread is quite literally the widest it has been since past 2005, not including a brief moment during the 2020 crash. And just a few days ago, the team over at Seeking Alpha released an article titled "The Top 5 High-Yielding REITs for Income Seekers." Now, I've been a fan of Seeking Alpha for a while now. I probably read dozens of news stories and analysis from Seeking Alpha every single day, and it's also where I keep a lot of my stock watch lists. So in this video, we'll be analyzing their article on the top 5 high-yielding REITs for income seekers. I also want to say thank you to Seeking Alpha for sponsoring this video. Seeking Alpha is the investing platform that I've been using longer than any other, and they just started their Black Friday sale. If you've never tested Seeking Alpha out before, you can currently get a 7-day free trial, and if you like it, you'll get 20% off your first year. So really, it's risk-free. If you haven't tested it out, I'd highly suggest you do so. And once you join Seeking Alpha, be sure to give me a follow over there. I put out analysis periodically. So again, be sure to check out Seeking Alpha. You can get the discount at the link in the description. Now, as we analyze these REIT picks, it's important to understand the REITs they're selecting. They're looking for high-yielding REITs for income seekers. Now, this is important to note for a few different reasons. One of the visuals that I always love to point out and concepts I love to talk about is the dividend growth pyramid. What the math behind dividend growth and high-yield investing tells us is that over the long term, a lot of the times dividend growth stocks can actually pay out more in dividends. But if you have a shorter time horizon and you're looking to maximize dividend income right now, obviously, you're going to tilt towards the high yielders. So what we're looking at today is closer to the bottom of the dividend pyramid, looking to maximize dividend income. A lot of people will claim that high yield investing is riskier, but that's not always the case. It completely depends on the fundamentals. So let's dive into it. We can see the number one REIT in their top 5 REITs for income seekers is none other than Vici Properties. This is a REIT that I talk about on the channel pretty often. Now, if we look at Vici in the last year, they're down by about 5%, and year to date, currently up by about 3.37%. But we can see that starting dividend yield for Vici is now sitting close to 6%. So that's a relatively high yield. Now again, like I mentioned earlier, the REIT market in general is trading at a very discounted rate, but it's not just discounted when we compare it to US equities, which have been on a huge bull run due to the AI race. They're even undervalued based on their historical valuations. That's an important note to make. In fact, if we look at the historical price to AFFO per share for Vici Properties, we can see compared to how they've historically traded, they're still trading one of their lowest valuations really since this REIT started publicly trading. So let's find out what argument that Seeking Alpha makes for this REIT. They state that Vici is a great addition to a defensive income sleeve for investors as the market rotates away from the AI-fueled risk. And one of the reasons they state this is because of Vici's portfolio. If we jump over to their investors presentation, which was updated just a couple weeks ago, we can see what they mean. Vici currently has 100% occupancy. Obviously, it doesn't get any better than that, and then we can see 100% of their leases are triple net leases. Essentially what this means is the tenant is responsible, not the landlord, which would be Vici. The tenant is responsible for paying all taxes, net insurance, net maintenance. And what that does for Vici Properties is it makes their cash flows extremely predictable. But here's what's interesting about Vici Properties right now. We can see their 3 largest tenants make up over 80% of the total rent that they collect. What else is interesting about this? They're all located in the same area, and that's Las Vegas. Now, in some ways, that could be an advantage for the REIT if that area continues to do well. But the reality, and this is something that I was talking about over on Dividendology.com just the other day, but Las Vegas tourism for the first time in years has actually declined in 2025. It was down by about 7.9% through September. Now again, we have to remember at the end of the day, a REIT is only as good as the tenants in its portfolio. And I think this is what scares a lot of people, but here's what we need to make note of. Vici has a 100% rent collection history since IPO, which means even during COVID, again, collected all of their rent. That was extremely rare for REITs. They have long-term inflation-linked leases providing inflation protection. This is something they highlight in their investors presentation. As we mentioned earlier, they use triple net leases, have 100% occupancy, and they also have an investment-grade balance sheet. So in regards to Las Vegas tourism being down, yes, that's not necessarily a good sign for Vici, but it's not something that's going to hurt them in the short term. This would have to be a long-term downward sustained trend for this really to harm Vici. And as Seeking Alpha points out, Vici is actually expected to grow funds from operation about 8.46% in fiscal year 2025, and revenue should be up by about 3.86%. So when you combine all that with the fact their starting yield is around 6%, and if we look at the dividend growth history for Vici Properties, the 5-year sitting at about 7.4 and the 3-year very high at close to 6%, the dividend metrics look quite attractive for this REIT, and we can see the dividend safety looks good as well, as the AFFO payout ratio is currently sitting in that 74% range. And if we just quickly run Vici Properties through a dividend discount model, you can see it appears like there's upside. Assuming they achieve just 3.5% dividend growth, which for reference is even slower than the rate they're growing adjusted funds from operations, meaning that should be sustainable, then the stock would be worth about $36.17 per share, giving them 20% upside from their current share price. Now, the second stock on Seeking Alpha's list is an interesting one. We have Alpine Property Trust, and this is not necessarily a very popular REIT. Let me show you one of the reasons why. To start, the market cap is only about $252 million. This is a very small company. If we look at their investors' presentation, we can see they only own around 128 properties. Now, year to date, they're down by about 2%, but they've seen a huge spike up in the last month. They're up by about 18%, and this is also a high yielder. They're currently yielding close to around 7%. So why did the stock see such a bump up in the last month? Well, really it boils down to their recent earnings reports. One of the things that happened in the recent earnings report is management announced they are increasing both their funds from operations and adjusted funds from operations outlook for the full year of 2025 to a higher range. So increased guidance is almost always some of the best news that you can see from a stock. And similar to a lot of REITs like Vici Properties, they're still trading at one of their lowest valuations compared to how they've historically traded in the last few years. Their average price to AFFO multiple is about 10.96, and right now it's sitting at just 8.51, significantly lower than the historical multiple for them and also lower than a lot of their peers. Now the question is, who are their peers? Well, we have to understand that Alpine Property Trust focuses on single-tenant net leased commercial properties. It's basically a net lease REIT. So think of other REITs like Realty Income or ADC, Agree Realty. But there are some key differences. For one, they point out that the stock has the lowest AFFO multiple in the net lease industry. It's a well-covered high dividend, and a dividend that they have been growing as well, and they claim they have quality tenants. So let's assess these claims. Over here, we can see some of their top tenants, and we can see they're relatively concentrated. Their top 2 tenants make up about 22% of their annualized base rent, which is relatively high for a net lease REIT. If we look at those dividend metrics, we can see they've been growing the dividend at a slow rate since 2022, but it's well covered with a payout ratio of just about 62%. And on top of this, the yield is significantly higher than their peers, as we can see here, even despite the recent run-up in share price. Now, what makes this REIT interesting to a lot of people is they trade at a significantly lower AFFO multiple than their peers. At the time of this investor presentation, it was sitting at 8.1x, but like we just saw, it's now sitting closer to about 8.5. But with that being said, it's still much lower than their peers. Why would this be the case? Is this a massive opportunity? Well, in my opinion, here's the reason for the discount right here. Net debt to pro forma adjusted EBITDA. Essentially, this is a leverage ratio. The idea is we're comparing the net debt, which is simply the total debt minus cash, to pro forma adjusted EBITDA, which is a mouthful, but is essentially a cleaned up forward-looking version of EBITDA that shows a REIT's true recurring earnings as if recent acquisitions or sales and one-time items were already reflected in for a full normal year. Now, typically, we want to see most REITs being about the 4.5x to maybe 5.5x range. That's a healthy leverage ratio. But they're sitting at 7.7x, which is one of the most leveraged REITs that I've analyzed in quite some time. So as a result, they're going to have higher refinancing risk, higher sensitivity to interest rates. That doesn't mean that Alpine Income can't do well in the future, but it's absolutely something you have to be aware of if you're interested in this REIT. Now, one of the things that the Seeking Alpha team did point out is that Alpine also substantially accelerated the size and pace of advancements while enhancing the credit quality of its portfolio. For a REIT that's already pretty leveraged, as a potential investor, you probably don't want them making acquisitions unless it's also increasing the credit quality of the portfolio, which is apparently what they're trying to do. If we run this REIT through a dividend discount model, just like Vici, all the data will load in thanks to the ticker data add-on in Google Sheets. But if we look at our dividend discount model, how fast can this REIT grow dividends in the future? Well, we can see if we look at it through the lens of a reverse dividend discount model, assuming 0% dividend growth, the stock would be worth about $13.35. But with a low payout ratio and adjusted funds from operations expected to grow at a somewhat decent rate, even if we assume just 2% AFFO per share growth moving forward, the stock would be worth about $17.81. So it does actually look like there's some upside to this stock, but you have to remember it's probably going to trade at a slight discount compared to its peers due to the fact that really it's over leveraged. Now we come to number 3, which is Postal Realty Trust. And if we look at this REIT in the last year, it's up by about 11%, currently yielding over 6%. And if we look at its performance versus VNQ, the Vanguard Real Estate Index, it's outperforming by a wide margin year to date. PSTL is up 18.85%, while VNQ is actually slightly in the red this year. Now, this is a very unique REIT. Why is that the case? Well, PSTL is an internally managed REIT that focuses on owning and managing properties leased primarily to the United States Postal Service, USPS. And you may have heard me make the claim before that a REIT is only as good as the tenants in its portfolio. Well, it's pretty nice to have a tenant that quite literally can't run out of cash. It can just print more, literally. And looking at just a few data points, we can see why the REIT is actually outperforming the market year to date. Adjusted funds from operations per share is expected to increase significantly over the full course of 2025 compared to 2024. Look at same-store cash net operating income growth. They're projecting between 8.5 to 9.5%, which is very good for a REIT. And on top of this, in their recent earnings report, they saw beats on top and bottom lines, and they actually increased their 2025 AFFO guidance by about 6 cents. So again, it does appear there's a lot going right for this REIT, especially in the last few months. Last 6 months, up about 17.5%. Now, if we look at the dividend history for this REIT, what you'll notice if we zoom out is that dividend growth has certainly been slow, but it is growing. In fact, if we just take a look at the percentages, pay attention to the last 3 years, dividend growth is about 1.6%. Now, remember, anytime dividend growth is below the rate of inflation, they're technically paying out less in dividends, so that is something to keep in mind, but the yield is high. If we look at the payout ratio, again, we're looking at a REIT, so we pay attention to adjusted funds from operation payout ratio because dividends are paid out of AFFO per share. And this is sitting at about 75%. That's a healthy range for REITs, again, as long as they're growing adjusted funds from operation, which, as we just saw, is expected to continue to happen through 2025. PSTL currently owns around 1,872 properties in the United States across 49 different states with 99.8% occupancy. And according to Seeking Alpha, they're in a highly fragmented market with major growth upside, and that is what we saw that management was expecting. It owns 1,872 properties, representing only 8% of leased postal properties in the United States. So the total addressable market is still large. And recently, PSTL has posted huge growth in annual acquisitions. So they're trying to take advantage of this opportunity. Now, again, from a valuation standpoint, as you might suspect, like nearly all REITs over the last few years, they're trading at one of their lowest valuation multiples in the last few years. So let's just simply run them through a dividend discount model. Plug in PSTL. The data will load in thanks to ticker data. And again, let's run it through a dividend discount model. And again, this time, let's just assume that dividend growth is sitting at about 1.6% like it has historically been over the last few years. Based off that information, the stock would be worth about $14.28, or overvalued by about 8%. Now, the question we have to ask ourselves is, will dividend growth be faster than that? Because adjusted funds from operation is certainly expected to grow a little bit faster moving forward, just as we saw a moment ago, which is exactly what sustains dividend growth. In fact, one of the things they highlight is consistent dividend with annual increases and a declining AFFO payout ratio. If a REIT, or any stock for that matter, can grow their dividend while the payout ratio is decreasing, that's an ideal scenario. The dividend is growing, but they're also deleveraging. So in reality, the low dividend growth over the last few years was probably done in an effort to continue to deleverage. So perhaps moving forward, they could get closer to that 2% mark, which really would mean they're trading right at fair value. Pick number 4 is an interesting one, and one I'm not sure I'm completely on board with, but we have National Health Investors. And if we look at this REIT in the last year, it's flat, down about 0.22%, but year to date, It's actually up by about 12.34%. Now, this is a publicly traded REIT that specializes in investing in healthcare real estate, as you could probably tell by the name. And a lot of their focus is on senior housing. Now, one of the advantages of this type of REIT, and this is something Seeking Alpha points out, but the 85 plus population growth rate is expected to accelerate to 1.9% by 2030 and 3.5% in the following decade. So the demand should continue to be there, and if we just look at the analyst estimates as a result, AFFO per share is actually expected to increase at a pretty healthy rate moving forward. Now, what's interesting about this REIT is if we look at the valuation, it's quite a bit different than the other REITs we've looked at so far. The current price to AFFO multiple sitting at about 15.5 is actually higher than the historic average multiple of about 13.79. That's not like the other REITs. Now, one of the questions we have to ask ourselves is, why is that the case? Well, when it comes to that multiple, there's two things to account for. A change in price can impact the multiple, but so can a change in the adjusted funds from operations on a per share basis. So what's been going on with AFFO per share for this REIT? Well, if we look at Seeking Alpha and scroll all the way down on the income statement, we can see right here, adjusted funds from operations per share. There was actually a major decline in 2021, 2022, and in fact, 2024 was still not back up to where they were as of 2020. This is why simply looking at valuations can be a little bit misleading because yes, the valuation multiple is a little bit higher than its historic average, but it's because adjusted funds from operations has been declining. And if we look at this REIT in the last 5 years, it's only up by about 16.98%. Now, obviously, that doesn't account for the dividend, which is a major player in total returns when it comes to REITs, but still not ideal. Now, if we look at the yield, it's sitting at about 4.77%. And if we look at the dividend history for this REIT and zoom out a little bit, we can see they actually had to reduce their dividend after 2021. And again, the reason was because we saw a dip in adjusted funds from operation. Anytime AFFO per share drops, it's likely we're also going to see a drop in the dividend payout along with it. And that's exactly what's happened. Now, they started hiking the dividend again, but very slowly, just in the last few months. If we look at the 3-year dividend CAGR, it's only sitting at 0.18%, and the 5-year is negative due to that dividend cut that we saw. Now, if we look at their third quarter earnings results, we can see that net debt to adjusted EBITDA is at a ratio of 3.6x, so they're certainly not over leveraged. In fact, they're trying to leverage up more to that 4 to 5x range to continue to stimulate growth. A lot of the growth from this REIT lately has been driven by the expansion of its senior housing operating portfolio, which they refer to as SHOP. NHI transitioned 7 triple net properties into SHOP, where the company captures all resident fees and operating income directly instead of fixed rent payments. So it's a little bit of a different structure. And the CEO noted recently in the earnings report that acquisitions continue to meaningfully contribute to our growth, and we have already surpassed last year's investment activity with $303.2 million announced to date and more expected before the end of the year. The pipeline is in great shape, setting up 2026 for another year of excellent external growth. And this is a large reason why the company has increased its guidance recently. So when you look at the historical data, obviously there's some things that I'm not too excited about, but the REIT from a balance sheet perspective is certainly in a position to start ramping up growth. And they did just bump up their guidance when it comes to adjusted funds from operations. So it's not all bad news for this REIT. If we go ahead and jump over to our valuation model, again, let's look at that dividend discount model. Now, what we're going to do for this REIT is look at it through the lens of a reverse dividend discount model, and I'll show you why. It's because there's a lot of dividend growth currently priced in. In fact, if we assumed 0% growth, it'd be worth $42.59, which is about 45% off from the current share price. So how much do we have to bump up the dividend growth rate to get to that current price? If we start at 2%, we're not there. At 3%, we're still not there. If we bump it up to about 3.5%, still not there. And at about 3.7-ish%, we get very close to the current share price. So essentially, expectations are that dividend growth is going to ramp up for this REIT significantly, and the reason is adjusted funds from operation is projected to start growing at a much healthier rate than it has in the past. That's the trend we're seeing for a lot of healthcare REITs. And then finally, we have Milrose Properties. And there's a high likelihood you haven't heard of this REIT unless you're heavily researching the REIT sector, because this REIT just started trading back in early February of this year, but they've done quite well since then. They opened up at about $21.94, and they're now trading at $29.50. If we look at them in the last 6 months, they are only up by about 2.79%, but that's because we've seen a bit of a pullback in the last month. And that's despite them seeing beats on top and bottom lines, and like a lot of these other REITs, raising guidance for year-end adjusted funds from operations quarterly run rate to a range of 74 cents to 76 cents. Now this REIT already has an incredibly high yield, the highest we've seen on this list at 9.37%. But I have to say this REIT is incredibly different from the other REITs that we've analyzed thus far. MRP is essentially a land banking REIT. So what that means is instead of actually owning buildings and collecting rent like most traditional REITs that we've looked at so far, what MRP does is they go out and they buy raw land, they develop it into finished lots or home sites, and then they sell those lots to home builders. So if you're wondering, is this really even a REIT? Well, it does technically qualify as a REIT because its land inventory qualifies as real estate assets and its income comes from the sale/ownership of real properties. However, there's also risks associated with this business model. Home building is one of the most cyclical businesses out there, and revenue can be very lumpy, up a lot one year and down a lot the next. On top of this, if they're holding land value can fall during downturns. And then if we compare them to other REITs, most REITs have tenants with long-term leases providing predictable cash flow. MRP certainly does not have that. Now I know it sounds like I was being harsh on the business, that's not necessarily the case, but you need to understand the risks with this business model. So really one of the main things we want to look for as we analyze this REIT is whether or not book value per share is actually growing. Why is that the case? Well, it means the company is increasing the value of its net assets, which is just simply assets minus debt, for each share that you own. So basically, we want our ownership claim on the company's real estate to get more valuable. Now, what are the ways that they can achieve this? Well, the land value could increase. Their development of raw land could create additional value. They could sell the lots above their cost. And then they can reinvest that capital at higher returns. Now, look at what they stated here. MRP intends to distribute 100% of earnings back to shareholders. That's a very aggressive dividend policy. And what we can see is their distributable earnings in the recent quarter didn't actually cover all the dividend payout. And in fact, if we just go back over to Seeking Alpha and look at the dividend safety, right now their AFFO payout ratio is nearly 99%. So this REIT is a very aggressive REIT. I want to be completely clear. Now, one of the things Seeking Alpha does point out is they have 138,691 home sites in its portfolio across 30 states, total land assets of $8.7 billion, and liquidity of $1.6 billion. MRP is growing in an industry experiencing favorable structural forces with housing inventory tight and home builder net leverage at record lows, and we can see this charted out right here. So the hope is this will be an advantage for MRP. So if we just simply run them through a dividend discount model, we'll jump over to that tab, and again, we're not going to have any historical data since the REIT just launched, but we can see at 0% dividend growth, the REIT would be worth $21.18. So again, the market is expecting them to grow adjusted funds from operations and as a result, actually grow the dividend. So right now, it looks like there's about 2.25% dividend growth priced into this stock. There is very little margin for error when it comes to this REIT. So there you go. Those are the top 5 high-yielding REITs for income seekers, according to the team right now over at Seeking Alpha. There are some pretty unique REITs on this list and some great case studies. Again, if you're not currently a member of Seeking Alpha, I'd highly suggest you at least check out the free trial. I get the feeling you'll like it. The Black Friday sale doesn't last for much longer, so be sure to give it a chance. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.